But even in real dollar price terms, silver would probably be $100, $200 right now just to match those highs. Either silver is totally a piece of something you don't want to own, or it's lagged and it's going to catch up. You're going to have a crisis that isn't just print-awayable this time. It will cause doubt and change in institutions. My bet is you won't have a Federal Reserve in a year or so. All these kind of things that we think as norms could go out the window. And the same is true with the monetary metals. This time we think when they go up, they're likely to stay up, meaning become institutionalized again here, there, this country, that country, as money.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for August 25th through September 1st, 2025, while supplies last. First this week, 1 ounce gold Britannia are just $60 over spot per ounce. Next, 1/10 ounce gold Canadian maples are only $35 over melt per coin. 1 ounce silver maples are just $2.89 over spot. And 1 ounce silver kangaroos are only $2.79 over spot per ounce. And with a 250 ounce monster box, they're the lowest priced monster box available. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us today.
Good to be back, Elijah.
Well, it's great to have you today. We had you on a couple months ago, and you were talking about really a breakout in momentum that you were looking at, and that's what you specialize in. Instead of looking at the price, you look at the momentum movements, and now we are seeing a lot of that breakout really materialize in the price. We're seeing silver breakout finally above $40 an ounce. We haven't seen this in over a decade. Your take on where we are right now?
I think silver is likely between now and the year end, and maybe sooner than that, take out its old dual highs at 50. First off, they're phantom highs, meaning when we were there before, it was very brief anyway, like hours or a few days before it collapsed. But even in real dollar price terms, adjusting for the degradation in the money unit, which goes and increases in supply about 90% every decade, silver would probably be $100, $200 right now just to match those highs. Okay. And then put it another way. Either silver is totally a piece of something you don't want to own, or it's lagged and it's going to catch up. Now, what do I mean by lag? Look at copper. It's above its 2011 high. Gold, well above its 2011 high. Gold miners on Friday, XAU blew out its 2011 highs. GDX made a new high monthly close. Not above the intra-month highs of 2011, but a new high monthly close. And silver's at 40, 42, we're almost today. I think silver's going to do a big catch-up. And I think while gold continues up, and now it's come up out of its 5-month wide range, 3,500 to 3,200 back and forth, just sleepy as hell, but no real break. And silver gained during that time quite a bit. The spread is starting to favor silver now, meaning what's the better performer? Yeah, right now silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months, and we're going to say, oh, wow, finally, the beast is out above its all-time highs. It's like 60 or 70, which is sort of a broad working target we have for the next surge point, okay? Not that it's going to peak there, but that we're going to blast through those old nominal highs and not even pause until we get credibly out above them. And then maybe you get a correction of some kind, not the end of the bull. But I think that's what we're facing right now. So yeah, momentum said, back in early June, watch out, I'm going to blow out the dual highs at 35. October last year, March of this year, we dropped all the way down to under 28 in that period of time. And when we came back up through 34, got up to the upper 34s again, momentum said, you're gone, you're going to take off. And I think it's only just begun.
the all-time high is just less than $10 away now. And we've been talking with you since silver, was like $22 or so. So it's almost doubled since then. So another $9 or so really seems quite realistic at the moment. And as you're mentioning, it's probably going to blow through that all-time high. And I mean, if you look at inflation adjusted all-time highs, it's well above $50. So do you think traders will be looking more, will pay less attention to that $50 level, since it's really just a nominal high? It doesn't reflect anything in reality.
I think anybody who pays attention to those old highs as if they're important is illusory. Okay, it's for the reasons you just described. First off, they're ancient, and and look around you at the other base metal, copper, gold miners now. And why is silver? It's a dog? No, it's not. It's just been overlooked, and investors quite often do that. They make mistakes. They underprice things, they overprice things. In the case of silver, it's vastly underpriced. We're also watching something that very few people look at. We keep the spread between gold and silver. The way we do it is we divide an ounce of silver to an ounce of gold and express it as a percent. Silver recently got a pullback low that was slightly below 1% of the price of gold. Well, in our weekend report, we showed going back to 1975, what was the highest reading that silver-gold spread reached in each of those years? And 20 of those 50 years, it reached at least 2%. Okay? And in bull trends, like 79 to 80, 2010 to 11, silver was at 3.5% to 6%, the price of gold. Okay? Right now, we're, above 1%, and we're pushing up, toward 1.2%. Not far above here, when we run momentum of the spread chart, we're going to get a breakout. And when we get that, we'd expect the spread to also break out. Now, there's a level on the spread at 1.31%. What's that? Over the last 5 years or so, there have been 2 rally highs in the spread that halted at that level. You ever clear that, it's a horizontal range breakout for the spread. And historically, if you go back and look at this performance of that relative performance of silver to gold, whenever silver's beating gold, is surging upward, that converts into net price upside in both metals, meaning silver doesn't outperform gold because gold goes down more than silver. It's always silver outperform gold when they're both going up. Get the point? So while everybody's looking at price, we're also looking at the spread, and it's about to engage in a major breakout as well. And when it does, I think that spread is at minimum going to go to the norm of 2%. Well, heck, that's almost a doubling of its current relative value. I think it'd occur easily by year end. Now, what does that mean? Well, it means, if gold just stood still and silver went to, 2% of it, silver would be $70 or so, But gold will be going up there in that time. It's just that silver will be outpacing it. So we think right now the place to be most focused in terms of holding a position is in the silver component of the monetary metals.
As we speak, gold is breaking out as well. It's just not as big of a story because so many people have been looking at the $40 level for silver. Gold is breaking out. It seems pretty much to all-time highs, about 3,500, almost 3,500 as we speak here on the morning of Labor Day here. So did you want to give your analysis of what are you seeing in momentum right now for gold?
Well, gold's momentum is positive. In the 5 months of horizontal price action we've seen, it allowed all the doubters, and there are ever doubters out there. It's got to correct. It's got to go back to 20, this level or that level, some old high, and it didn't do it. They sold into it repeatedly, like 3 times. It got up to 3,500 or 3,450. Right now, we did trade above 3,500 today, by the way, using October gold. They couldn't break it. They sold it, and they kept getting these $100, $150 pullbacks, and then bang, you're back up again. So I guess they got taught a lesson that this is not some beast that has to correct big time. Instead, it had a correction by standing still for 5 months. And our work on momentum and clockwork of momentum, meaning often momentum swings can be measured on certain of our metrics in terms of how many months have been spent trending up on the oscillator or down on the oscillator. And for that 5 months, we've had a corrective downside process in momentum as it cooled off while price went lateral. The clock is old. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000, okay? But we're focused right now on MSA on this issue. This particular surge will not end the bull market, but it will be dramatic. And therefore, if you're invested in the monetary metals, particularly the silver side and the gold miners, which are now also outperforming gold, we're looking for points to take profits. But I'm going to tell you that in the case of silver, we're not looking for it, frankly, until we get to 60 to 70. Because we've blown out the idiot highs, which means, pardon me, those who missed the move had ignored it and doubted it, will suddenly say, well, golly, I got to be in that, okay? And then you get a further gush of money into a fairly small market, which could easily goose it into that zone, and we've got some reasons for that zone. But ultimately, there could be a correction up there, not the top. So if you're fully invested, unleveraged, ignore what I'm saying. Because I think we've been arguing that this move in gold and silver is different from the prior ones. This time, I think there's more fundamental and macro technical events going on globally and in major asset categories, not just a stock market top, which I think has been making since early this year. It's a widening top, but it's a topping pattern. But in certain other areas like the breaking of the dollar, dollar has not been a factor, the dollar index, when you measure it versus euro and yen primarily, that's 70% of the dollar index. It's been sideways since 2015 when gold made its low. It's trading around 98 right now. We're trading just below 98. So, yeah, it's been above it and below it since then. But 10 years, it's been net lateral. Well, why is gold not net lateral? It's triple and a half. So you don't just look at the dollar for driving gold, but it will help because it's now entered what could be a dynamic bear market. And dynamic on the downside could, in fact, be further wind for gold. Then we go to the T-bonds. T-bonds are usually an alternative. If you have a perception of a weakening stock market, people will tend to move money into T-bonds as the alternative. They're not. T-bonds are very anemic. They're very weak. They're behaving more like the stock market in terms of when they make lows and highs. And right now, T-bonds, as we speak, are not far away from some levels that if they break below, you could end up getting a little mini bond market event, which would spook the stock market. Anyway, there's a lot of these factors out there, including Bitcoin, I think, which is in a potential crash situation. We've been saying that for a few months. Not that we're there. The trigger numbers are still below us, but if you hit those trigger numbers, that could suddenly become an off-the-sideline type, oh my God, where did that happen? How did that occur? And it will have wave effects because of financial institutions that are now so heavily involved in crypto. So anyway, these events are out there percolating, and I think they're going to occur. And when they do, that could create further upside panic in the monetary metals. And I think we're going to see that between now and the end of the year, possibly sooner than that.
Now, you mentioned in your weekend report that it's a good idea to remember that this is, in gold and silver, this is not simply a trade. This is actually kind of a situation where people are waking up to the fact that gold and silver are real money and government currency ultimately doesn't have any intrinsic value. So can you give us your perspective on that, how this is fundamentally different than the bull markets in the bull market in the 1970s, 80s, and then also in up to 2020 or 2011?
Well, for about 100 years now, we've had the phenomenon of governments excessively pushing the pedal and using money as their tool of survival, okay? And in the process of decaying the real buying power of their money units, euros, yens, dollars, whatever, such that, what I mean decaying the value of money? When your granddad built a house, it cost him $4,500. Now it's $450,000, okay? That's an example of degradation of money over, a span of 100 years. it's created boom-bust cycles. We've seen them. We've seen monetary excess, and then stock market booms, and then stock market peaks and goes down regardless of whether the Fed cuts rates to try to defend it. It goes down anyway. And you get these boom-bust cycles created by monetary excessive flows, lower interest rates than reality would have them. Various monetary policies like QE, which they engaged back in 2008, which is now in their quiver, okay? You break the stock market in a few of the, especially certain arenas that I've been mentioning, including, by the way, the banks look very vulnerable technically, especially as we get into next month. All these events could cause the Fed to go berserk. The question is, will this game, this boom-bust cycle game where they come in and they try to put the fire out by printing a lot more money, buying assets, cutting interest rates below any reality point, will that work again? We argue no, this time it won't. This time the boom-bust will end in something more global and more painful to the average guy than 2008, for example, or the dot-com collapse. This time it's going to be more broadly felt. First off, we have the biggest stock bubble in U.S. history in terms of duration of years upside, the multiple gains in the price of the stock market. NASDAQ 100 went up like 20-fold from its 2009 low over a 15-year period plus, and S&P went up over 10-fold. There's no bull market in history that matches those dimensions. And when you look at money supply or you look at Fed funds rates, you can say, oh, now I understand why. They printed it higher. Okay. When that breaks, real-world consequences occur. This time, I think they'll be so severe and also global, although we're a prime bubble. Some areas of the world aren't. China, for example, does not have a bubble situation. They may go down with us, but they don't have a bubble. But it will cause real-world, in-the-street consequences where certain things that we all take for granted but really have only been around this century, one very long human lifetime, such as central banks controlling what money is. Why should you have a government monopoly over the most essential commodity of human interaction? Money. Okay? It's as if government controlled the price of corn, determined how much is going to be produced each year and what its price is. Well, we would call that socialism, right? Okay? Which it, would be. Well, what controlling the most essential commodity in human interaction, a money unit, is even more manipulative and controlling and less free market than any action they've done. But when that process proves that it doesn't work and proves it in a way that's painful to too many people, then you have doubt. And not just among the average guy who's hurting, but academicians who look at these institutions and say, hey, this hasn't been working. It's just been this recurring process. Or like Jamie Dimon made a point, a month or so ago about the bond market situation. It's this constant process of the degradation in government debt in relation to its ability to, raise the money, et cetera, et cetera. It can't go on forever. This time it's going to be different. And we think he's right. I think it's going to be true. You're going to have a crisis that isn't just print-awayable this time. It will cause doubt and change in institutions. My bet is you won't have a Federal Reserve in a year or so. If events get real dark economically, you may not have income taxes. Why? Because it's simply dysfunctioning. Public can't pay it. And the IRS doesn't function in terms of the percent of revenue it's supposed to bring in. So, they go to sales tax or something. But all these kind of things that we think as norms could go out the window. And the same is true with the monetary metals. This time we think when they go up, they're likely to stay up, meaning become institutionalized again here, there, this country, that country, as money.
You speak of that the Federal Reserve might not even exist in a year. I think that is definitely a shocking statement, but looking at how Trump has been interacting with the Fed and speaking of the Fed, I guess it's not too out there, right? Because it seems like there's more and more political influence in it, and the whole idea of an independent central bank might just completely go out the window. Can you expand on that?
Yeah, I think a lot of people think of Trump as free market, and I don't think of him that way. He's very interventionist in a lot of things, not merely government agencies, but send troops here, send troops there. do this, then change it and do that. Tariffs here. Tariffs are taxes, after all. They get passed along in the process. And some people recognize that, even people on the right who used to be Republicans and now are no longer part of the Trump party. And even JD, well, Trump likes also to print money. Back, before COVID even hit, he was talking about we need to cut rates below the Europeans and get them to zero. Because why? We should have cheaper bonds than they do in terms of the interest rate. We shouldn't have to pay so much for service our debt. And so he told the Fed then, but he didn't do anything about it. Fed later did cut rates to near zero. But anyway, the point, he's still talking that way. I want rates at 1%. Well, and that's not a market pricing of an essential commodity. That's a government edict. And so naturally, he wants to control the Fed to control that aspect of the economy. Well, I mean, Mussolini would have liked that too. Pardon me for saying that, but that was his view of his adaptation to socialism. Wasn't we nationalize companies and so forth, but we control them from above without seizing them. And we control money and so forth. And Vance, though, the other day made an interesting statement. He said, why should we have a group of academicians determining the price of money? In other words, he was questioning intellectually the even existence of a Federal Reserve, which a few libertarians have done, but now even the VP mentioned it. Now, Trump hasn't because he'd like to control it, get rates down. But these are the kind of changes I'm talking about. What will cause them? Events, trends, and pain. And if we're correct in our analysis, monetary metals are going up. 2, certain other assets are going down that are bubbles. And also certain other areas will ambush, I think, the average guy. Remember, the guys who voted for Trump were, one, the GOP regulars, but also blue-collar workers who said, hey, he's going to keep prices down, particularly gasoline prices. And this year we saw lower prices. Well, that wasn't because of Trump. That's because oil has been under pressure and so have commodities. But our technical analysis of the commodity category, and particularly crude oil, is that you can't sneeze on the upside, because if you do, you're coming up out of here big. There's going to be a whole nother commodity upwave, like we saw between late 2020 and 2022 when commodities doubled. Still at low levels on the Bloomberg when it did double, but it doubled. And I think we are in a technical situation where that's one of those ambush events that will help cause doubt and pain. Because when you're pumping the gas and all of a sudden it's 50% more than you paid 6 months ago, because oil goes from, we've got a major breakout starting next quarter at $68. Well, we're trading 64 plus right now. You go up $3 or $4 more between now and next quarter. In next quarter, that's going to be a breakout level. And oil is going to surge. And I'm not going to explain why, because I don't know why. Don't care. But technically it says I'm going up. And the Bloomberg Commodity Index is in the same position. So again, here's an event that could occur. It's likely to occur in our assessment. And when it does, it's going to be an upset factor, meaning emotion. And it's when you get the emotion in the game, that's when all of a sudden hands go in the air and you look around and say, where should I be? Well, you look at the charts and tell me, okay?
It seems like a lot of normalcy will kind of just be completely thrown out the window here if we look at, surging oil prices, surging prices across the board. This is, as you mentioned, really a different situation than what we saw in previous bull markets. Yeah, we saw inflation, but we might see inflation and kind of changes to the entire system more dramatically than in the past.
Well, we've had the inflation in the sense that the money growth continues. In fact, they're accelerating. The M2 money supply is making new highs now after a pause. That's an ongoing thing. That's why gold isn't $35, it's $3,500, okay? It's not because of any one single event or commodity inflation. And then, so the inflation really is always there. And that's why gold just keeps, over a period of time, it swings up and down versus that metric, but it's upward, just like the decay in the money units. But in the case of commodities, they don't explain. We showed in the weekend report the chart of gold since 2015, and there's this upward plotting action, and then it's accelerating. And you say, well, what caused that? And it wasn't because it was the declining stock market, which helps gold. If you go back 2000, 2002, 2007 high in the stock market to 2009. Gold went net up. There was one break in there, but it kept going up. But we don't have that right now. So it's not the weakening stock market yet. It's helping gold. So we will, because money will move. It's not reflected by the bond market. It's not reflected in commodities. The Bloomberg pullback from a high at 140 to either side of 100 back in 2022, dropped in 23, and then went sideways, has been dull for a couple of years. So it isn't commodity prices, so-called commodity inflation. You look around, and it's not the dollar. The dollar has been Deadsville. It's recently started to drop, but it's not precipitous yet. So how can you explain this? Well, because there's something bigger going on. It's not merely one of these things. It's a combination of things, largely built around the distortions created by government monopoly over money. And gold knows this. And later on, you'll see the headlines and you'll look back and say, oh, now I know why. But don't look for the reasons why to be in your face as it's doing it. Look for them later. Too late to be joining. Okay, not too late, but you're late. Okay, already you're late if you're not in. So that's why I think things will change more dramatically this time, is that all these factors, not just one of them, all of a sudden now we have a lot of factors that are at the point of cascade, which would create what? Total panic on the part of central banks.
Did you want to kind of wrap up by explaining kind of what you see from now to the end of the year in gold and silver?
Well, for silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, a wet bar of soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay. But if you historically, and I've said this over and over, and I'm not predicting the price because I could go way beyond it, gold has had a couple eightfold moves. 1976 low to the 1980 high, eightfold gain. 2001 lows, 2011 highs, eightfold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000. You would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay? So to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before, the same dimension move, you go to $8,000 gold, wouldn't shock me one bit, particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. And it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s, where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know. Not really.
It's pretty crazy to think that, $8,000 gold now, it doesn't seem too unrealistic, right? Given what we have already seen. So we really appreciate your time as always, Michael. If our viewers are interested in learning more and more about your analysis that focuses on momentum rather than price, they can go to olivermsa.com. Tell us a little bit about what they'll find there.
Well, we look at the 4 major asset categories in our all asset subscription. And why? Because these tectonic plates hit each other and they have impact. So you don't just look at gold and say, what's gold doing? You need to look at silver to gold. You need to look at T-bonds. What are they doing? Are they going to cause a panic? I look at the stock market. Is it going to cause a money flow into the monetary metals once it breaks? Look at the dollar, et cetera, et cetera. So these things are very important. So we look at them and we look at the momentum structures that they create, not merely the simplistic price charts. Price is usually lagged to its own momentum. Momentum speaks first, and price says, "Oh, I'll join you." Okay, so price is actually a lag technical indicator, and that's the way we operate.
Fantastic. Michael, once again, thank you so much for joining us today here on Labor Day. We really appreciate your time, as always. Thank you so much, and God bless.
Thank you, Elijah. Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for August 25th through September 1st, 2025, while supplies last. First this week, 1 ounce gold Britannia are just $60 over spot per ounce. Next, 1/10 ounce gold Canadian maples are only $35 over melt per coin. 1 ounce silver maples are just $2.89 over spot. And 1 ounce silver kangaroos are only $2.79 over spot per ounce. And with a 250 ounce monster box, they're the lowest priced monster box available. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.